On February 5, 2026, an additional set of declassified internal materials connected to JPMorgan's Treasury and Chief Investment Office entered the public record. According to journalists and analysts who reviewed these documents, the records span from the 2008 financial crisis through the post-pandemic recovery and reference balance sheet positioning strategies commonly discussed in institutional finance as liquidity capture, the practice of positioning early around large-scale central bank interventions. Analytical summaries of the materials suggest that during periods of aggressive monetary expansion, JPMorgan adjusted its exposure in ways consistent with institutions positioned closest to liquidity injection points. As newly created liquidity entered financial markets, value appears to have concentrated first within institutional balance sheets before diffusing into broader consumer prices. By the time inflation became visible at the household level, analysts note that much of this value had already rotated into higher yield instruments, equities, and real assets. This sequence reflects timing and access rather than any single policy decision. In Currency Wars, Song Hongbing describes this process as sheep shearing. Credit expands, asset prices rise, and purchasing power quietly migrates back toward those nearest to the source of monetary creation. Inflation, in this framework, is not portrayed as an accident, but as a predictable structural outcome of modern monetary systems, a redistribution mechanism that operates without legislation or direct consent. Institutions with early liquidity access do not react to inflation signals. They reposition ahead of them. While household savings gradually lose real value, balance sheets structured around monetary expansion appear comparatively insulated. The gap is not incidental. It is structural. Song Hongbing further argues that crises accelerate transfers already embedded within the system. Journalistic interpretations of the declassified materials indicate that during the 2008 financial collapse, JPMorgan expanded its institutional footprint while absorbing weaker competitors, in several cases with public sector support. Balance sheet strength increased even as households experienced historic losses. The records also reference continued high-value private banking activity during periods when broader financial markets were effectively frozen, illustrating how capital mobility at the top of the system operates under constraints very different from those faced by the public. From this perspective, periods of contraction function less as pauses than as accumulation phases. Analysts describe a pattern where institutions closest to liquidity channels store optionality during downturns and expand rapidly during recovery. While retirement accounts and wages adjusted slowly, large financial institutions emerged with greater scale, influence, and flexibility than before. This dynamic is what Currency Wars refers to as the invisible tax. The records suggest that elevated institutional profitability often coincided with sharp declines in household purchasing power, not because of a singular decision, but because of timing and structural positioning. Those without asset exposure tend to experience inflation first, while those with leverage and early liquidity exposure experience it last. By the time wage adjustments occur, value has frequently already migrated into real estate, equities, and private markets. What appears as open market participation can, in practice, resemble inventory supply for participants operating several steps ahead. The competition is not occurring on a shared clock. The 2026 disclosures do not describe a single scandal. Rather, analysts argue they outline a repeatable pattern in which proximity to liquidity matters more than effort, and survival favors access over participation. JPMorgan did not create inflation. The record suggests the institution understood its mechanics earlier and positioned accordingly within existing monetary structures. By February 2026, the final tranche of publicly released investigative materials connected to JPMorgan Chase entered the record. According to legal analysts reviewing the outcome, The multi-year process concluded not with executive-level criminal prosecutions, but with deferred prosecution agreements, civil settlements, and structural remediation measures, an approach consistent with how systemically significant financial institutions have historically been handled. The records reference extensive internal communications, repeated compliance escalations, and documented override events. Yet no individual criminal liability at the senior executive level followed. Legal scholars note that regulatory frameworks established after the 2008 financial crisis and reinforced during the 2020 pandemic effectively positioned certain institutions as integral components of financial stability infrastructure. Within these frameworks, institutional continuity is often prioritized due to the systemic risk associated with failure. In practical terms, the bank had become part of the financial plumbing. In Currency Wars, Song Hongbing argues that monetary power does not simply dominate markets, it persists beyond conventional notions of accountability. By 2026, this observation appears less theoretical. Institutions operating at global scale do not rely on moral narratives for survival. They rely on necessity. Financial systems prioritize continuity over correction. Losses are absorbed as costs. Scandals are resolved as line items, and disruption frequently results in consolidation rather than removal. The declassified materials illustrate a familiar institutional pattern. Compliance systems flag risk, escalations occur, and discretion is applied at senior levels. Analysts describe this as a structural feature rather than an anomaly. High-risk counterparties, complex private banking relationships, and opaque capital flows appear repeatedly throughout the record, yet remain difficult to prosecute due to how intent, authorization, and legitimacy are defined in financial law. What appears questionable at the transaction level often becomes defensible when evaluated at the balance sheet level. The system does not ask whether money should move, only whether it moved within permitted structures. Currency Wars concludes with a warning about debt, not as a burden, but as a binding force. The records suggest that modern economies are now intertwined with institutions whose balance sheets rival national output, creating closed loops where debt, liquidity, and settlement infrastructure converge. Participation becomes mandatory as alternatives diminish. At this scale, dominance does not require aggression. It is maintained through permanence. The system prevails not by force, but by being the only viable framework left. Across this series, we traced the pipeline of power, the information advantage, the invisible transfer, and finally, the durability of the whales. The declassified materials do not reveal a hidden conspiracy. They reveal a structure in which scale overrides accountability, and survival favors those embedded deeply enough to be indispensable. JPMorgan did not invent this system. The records suggest it learned to operate within it with exceptional efficiency. The question, then, is not why nothing happened, but why, within such a structure, anyone expected a different